All right. Exciting times. Great to see everybody. And my name's Andrew Stotz, and we're going to be going through all weather strategies and catching up on the markets and taking your questions. What a great opportunity to talk with you and also get the questions that you're focused on. I'm at my home studio, so you can get a picture of that here. But I'm welcoming every question that we've got. I know we're going to have some tough questions today. We've got 66 people on, and I know more are coming on. So welcome, everybody. And there's just so much going on. I think the biggest thing that's coming out is the U.S. inflation data will be coming out tomorrow. So we'll see where that lands, but I suspect we'll see inflation has come down even further in the U.S. If you recall, there was a couple of months ago, I was saying that inflation is just not going to rise much more, mainly because oil prices came down. And also what I saw was that it's a steady fall in U.S. inflation because of falling oil prices and also a base effect and some other factors. So we'll talk a little bit about that as we go through. I'm going to go through a bunch of stuff about the strategies and the performance of the portfolio, but isn't it romantic? Here we are on Valentine's night, celebrating together. I wonder how many people will come on today. Maybe a lot of people can't make it because it's Valentine's Day, but I just want to say hello to Nan and happy Valentine's Day. And also hello to, let's see what we got over here. So we got Patraton says, hi, Kun Andrew, nice to see you. And Dr. Fund Yai. Happy Valentine's, Kun Andrew. Yes, thank you. And to you too, Mr. Fund Yai. Nan, what's your guess tonight for CPI? Yeah, I think it's going to be probably less than 6.2. So my feeling is it's going to come down even lower, but we'll see. I'm doing some work on CPI right now, and I'll publish something in my podcast coming up on Friday. So my worst investment ever. If you're on podcast, check it out, and I'll be talking about it. All right. So why don't we get started, and we'll get straight into the strategies, and I'm going to share my screen and see if I can talk a little bit about what's going on. So now this is a review for January. We're doing it a little bit late this time. So you'll see some data is related to January, and then we have some updated charts. Remember that you can ask questions in the chat. Every time we go live, you guys send me so many good questions, and I hope that tonight you'll do the same. Tough questions are okay. I'll do my best to try to answer them. So first of all, for January, we had a strong equity market rebound. We're going to review our strategies and the performance. Remember, the all-weather inflation guard, that gained just under 1%. And the all-weather strategy gained about 2.2%. And the all-weather alpha focus gained about 1.1. And you may say, Andrew, that's amazing performance. Well, no, it's a terrible performance because the markets were up. They were hot in January, and we underperformed. We could have gotten more upside. But before I go into that, I want to explain a little bit about this for just a moment. And I just want to take a moment and highlight something I said about 3 or 6 months ago. I said, I would rather be defensive and miss the upside, right? I would rather be defensive and miss the upside than be offensive and participate in a crash. So in January, we missed the upside. And that's because of the positioning, the defensive positioning. And I'm going to show you in just a bit how even Warren Buffett gets it super, super awful wrong, and why we want to make sure we don't panic when markets aren't going the way we like. Remember, it's a long-term game. And basically what we're doing is developing these strategies for the long term. So let's take a look at the last part. Is I'm going to do some global outlook. And basically, we're going to go through all of this in the next, let's say, 40 minutes, and feel free to ask any questions along the way. So The first thing is world stocks rose by about 7.2% in January of 2023. That was a great performance. Now in 2022, of course, we know that world stocks were down 18%. The market was more optimistic in January, expecting a soft landing and avoiding a deep recession. Global bonds were up in January 2003. Rather than global bonds, though, we have target allocations to the time money markets in the AWS and AWAF, which was flat as expected. So remember, we're investing in money markets and bonds to protect against the downside. Commodities underperformed in January of 2023 and lost 0.8%, and that hurt us. And gold was up by 3.6% in January. Gold closed January at $1,928 per ounce. And of course, uncertainty remains high in the markets, which has led to continued momentum in gold. Now, I just grabbed this chart only minutes ago. I saw this article and I thought it was an interesting article. And this is a chart that shows the hypothetical $1,000 growth of Berkshire Hathaway shares, NASDAQ, and S&P 500 from January of 1995 to February of 2002. And what you can see is that Buffett's the red line. And basically, this red line did pretty well. We can see here the red line was even outperforming the market right here. And then all of a sudden, the NASDAQ took off. And Buffett actually underperformed because his stocks, nobody wanted them anymore. Eventually, he started to recover some of that and get higher than NASDAQ because NASDAQ closed and crashed. So Buffett suffered a 49% loss from January of 1998 to March of 2000. At the same time, the NASDAQ rose 140% and S&P 28. Now, why do I say about this? Why am I talking about this? I'm talking about this because I really want you to think about when the market's not going your way, how do you feel? How would Warren Buffett feel if the NASDAQ went up 140% and his performance was going down by 49%? He must have felt like an idiot and felt like he's got to change his strategy, but he just stuck with it. And I would say that that is the key to FVMR, is that we have a structure. The structure has two parts to it. The first part is about how we select stocks using FVMR. And the second part of the structure is when we select stocks. We look at the market every 3 months, and that's when we rebalance our portfolios. And that means that the market can go against us, and we just sit there. And we may underperform, but I'm willing to have some underperformance, knowing that in the long run, by sticking to our methodology and sticking to our method of selecting strategy and sticking to our timing of selecting strategy, that I believe we will win in the long run. So remember to ask your questions right now. Now is the time. Feel free to type that question in the chat. Of course, if you're driving your car, don't do it while you're driving your car. Stop the car, pull over, and then put your question into the chat. If you're sitting at home, feel free to type in the chat. I love to get your questions. I'm going to just look at some of the questions. We were just talking about CPI, and Nan asked, what's your guess for CPI? 6.2 or more. I would say that CPI is probably going to come down in January. We'll get that data coming out soon. And you said, with a mixed economic data, wondering US and EU is going to recession or not this year. Okay, we're going to come back to that and talk about the recession or not and what's going on. All right, Glissana says H, which I'm going to assume Glissana is saying hi. All right, let's go back to the presentation. And I want to continue on and talk about the performance review of the all-weather inflation guard, which rose by 0.9%. Remember that inflation guard is a low-risk strategy, and equity is 30%, and bonds are 60%. We've made no changes to our allocations in this performance review. Now, since inception, the strategy was 1.2% below a 40-60 portfolio as of the 13th of February, 2023. So we've updated it for February now. The strategy has experienced less volatility, that's for sure, but there's a little bit of underperformance after fees. And that's what I'm saying. It wasn't a great month. The strategy was 1.7% below the 40-60 portfolio, though the strategy rose by 0.9% in January of 2023 as markets rebound. So we were up a little bit, but we weren't up nearly as much as the 40-60 portfolio. Like I say, you win some and you lose some. Our allocations to healthcare, commodities, and energy drag down our performance. The World Equity Fund lagged the MSCI All Country World Index also. Now let's look at the all-weather strategy, which rose by 2.2%. Our allocation has been 25% to each asset class, and we make no changes right now to the strategy. Our next change in the strategy, I believe, is coming early March, I believe. I think Alex is on the call, and he'll fill me in on what that is, but I think it's early March. Yep, he says yes. So for those people that are going to ask the question, when are we considering rebalancing the portfolio, it will be early March. Now, since inception, the all-weather strategy was 5.2% above a 60-40 portfolio as of 13 February 2023. Remember, this is after fees also. The strategy was 1.7% below the 60-40 portfolio. So we didn't do that well, although we were up by 2.2%. Our low 25% allocation equity was a major cause of that underperformance in January of 2023. Now let's look at Alpha Focus. Now keep in mind, Alpha Focus is where we're making our biggest bets. And that is an area that didn't perform nearly as well as all-weather strategy. It just was not a great time for Alpha Focus. We had 73% allocated to equity and commodities at 22%. So we were really exposed to the commodity cycle. We've made no changes to the performance or to the allocations. Again, we're going to do all of that in early March. Now, since inception, the strategy was 1.3% below the 60-40 portfolio as of 13 February 2023. Now, remember, these strategies are relatively new, but here we can see we definitely had some underperformance in the latest month of January and into February. Now, since inception, the strategy was 4.4% above world equity as of the 13th of February 2023. So if somebody had just put their money into the stock market, they would have had less of a performance than this. Of course, the volatility of the all-weather strategy was less than the overall market. So the strategy was 2.5% below the 60-40, and you can see at 1.1% that it was up. The strategy was 5.5% below equity, so equity just blew it out in January, and we did experience the case of being relatively underweight equity and not getting the performance from it. Now, the strategies are performing pretty much as expected. The all-weather Alpha Focus, if we look at them, so what's different about this chart is that we've rebased the strategies to 100 here, and we've started in July of 2022. So this is not from inception. The reason why is because this period, July 2022, is when all three strategies started to be available. And so that's when we decided that we wanted to show the performance since that time. We can see Alpha Focus is more volatile, and we can see also outperforming, and it's outperforming on this period since July 22nd, which is when the inflation guard strategy started to be available on Phenomena. So what you can also see is that inflation guard, the green line, is very, very stable. So this gives you a picture of what's happened. We started the all-weather inflation guard in July of 2022, so the period of comparison is short. All-weather Alpha Focus has had the highest return and volatility. And inflation guard has had the lowest volatility and returned slightly better than the all-weather strategy. So it was a good time for these strategies. Now, all strategies have had lower volatility than world equity. So all I've done here is just put the world equity chart on there. So as of the 13th of February, 2023, all-weather alpha focus was on par with AWIG and AWS. They were below world equity in terms of return. So let's talk about the global outlook. But before we do, let's just take a moment and feel free again to ask any questions that you may have. I just want to welcome everybody on. We've got 125 people showing as being on this stream, and I just want to welcome you on. Feel free to ask any question. I'm more than willing to try to answer. And Glissana says, good evening. Happy Valentine's Day. Let's see, it's a big one. Happy Valentine's Day. My people have a good day and a good time. God bless family always. This is my room. Here's nights to meet up. So great to see you, friends and flowers. I spent Valentine's Day with my mother here in Bangkok, Thailand. We had a lovely day. And my mother was just getting a massage. A lady came to the house and gave her a really nice massage. And she was so relaxed. She's having a glass of wine and some dinner right now. By the time we're done, she's going to be resting in bed. All right, let's go back to the global outlook. Feel free again to ask any questions. When it comes to equity, it looks like US CPI appears to be past its peak now. If no significant oil price moves from here, it could be the peak for US CPI, and we could come down quite a bit. But the feed through of high oil prices could keep food and everything else high, meaning no extreme fall in US CPI over the next few months. Here we can see that Euro area inflation has also slowed down as well. That's the blue line on this chart, which shot up higher, but then started to come down. Now, a March Fed rate hike seems to be priced in. The market is pricing in an 86% probability for another 0.25 rate hike at the next FOMC meeting. And that's a pretty small rate hike compared to what we've been seeing in the past. Now, the latest and most aggressive rate hike cycle is this one since the 1980s. After the 0.25% hike on 1st of February, the current rate hike cycle became the most aggressive since the 80s. And here we can see since March 2022, the market expectations have shifted to a much more aggressive Fed. And we can see that the market expects that the target rate will peak in about July 2023. The Fed is aggressively tackling inflation, which raises the risk of causing a massive recession. Actually, I think this is probably one of the most difficult questions we face. Are we heading into a recession or a soft landing? Well, I think there's still enough signs that we're heading into a recession. Here's the yield curve inversion, and it just keeps getting deeper. All recessions in the US since 1968 were preceded by an inverted yield curve. The average time from inversion until the recession started was about 1 year, which means that the recession should hit in mid-2023. Now, remember, keep your questions coming. I see Lana Fernandez has asked a question, and I'll come back to that when we get to the question section. Please keep putting your questions into the chat, and I'll do my best to answer them when I get through the presentation. Now, valuations have come down primarily due to the price fall. You can see the red line is the forward PE, which has collapsed from about 20 times PE down to about 15. But what you'll also notice is that the blue line, which is net profit margin, has not come down that much. This is a forward net profit margin, meaning this is what analysts are forecasting. And I would say analysts are still pretty optimistic. World stock valuations is now around its long-term average. While the consensus net margin has come down a bit, the downward revision is likely not enough. We probably are going to see more. So, strong US dollar also hurts emerging markets, and a weak US dollar helps. So a strong dollar is negative for many Asian markets due to US denominated debt is getting harder to pay back. Further, US dollar depreciation could be positive for emerging markets. And I would say that's part of the story here is the US depreciation is starting to make emerging markets more attractive. For the past year, we've said that we think the Fed is going to eventually reverse course. We think the central bankers and politicians will change course and return to accommodative policies as soon as something breaks. And we think that the central bankers are going to break things. Central banks may kill growth, but not inflation. And we get stagflation in that case. Stagflation is typically bad for both stocks and bonds. Commodities have typically done well during inflationary times and have been resilient during stagflation. Gold has historically fared well during stagflation. Let's look at bonds. Bonds are typically a safe place to be, even though 2022 was exceptionally bad. Remember, keep your questions coming. Feel free. I'm going to be answering them as soon as we finish the presentation. In recession, safer assets like government bonds are typically performing well. Though with high inflation, low yields could still lead to negative real returns. We typically don't allocate to bonds to speculate on the upside, but rather use bonds as a way to protect capital over time. So now let's look at commodities. Here you can see the Strategic Petroleum Reserve and the absolute collapse when the Biden administration sold the Strategic Petroleum Reserves out into the market. Fundamental support for energy prices, well, OPEC Plus keeps missing its output targets, and the cartel has announced to cut production and support oil price. Geopolitical conflicts and wars could lead to further supply shocks, and energy prices can also remain high due to past underinvestment in new projects. Food prices have softened, but supply for agricultural commodities could tighten again. If the trend continues, it would help to lower the pace of inflation, and volatile natural gas prices, La Nina, or export bans could lead to a rebound in food prices. Commodities have fundamental support. Demand for necessities like food and energy, inflation, and supply chain disruptions related to or unrelated to the war in Ukraine are going to keep commodities prices relatively high. The reopening of China could lead to increased demand for commodities. Also, if we're going to go into a stagflationary period, then you could say that commodities would be our best defense. Let's look at gold. Central banks have been loading up on gold, maybe switching from US dollars. We can see the last time we looked at it for fourth quarter, we added our estimate on there, but there's been a massive amount of gold buying by central banks. And we keep gold as insurance. The war in Ukraine spurs uncertainty and inflation expectations could rise, making gold attractive. In general, gold protects value in times of uncertainty and market downturns. Now, what are some of the risks? Inflation quickly gets under control, which we're seeing that happen. Central banks have aggressive rate hikes, and QT crashes the stock market. It's possible. We're underweight equities, so if central banks pivot and stocks go up, we'd miss that upside, and that's one of the risks we've been talking about, and that's part of what we missed in January. We are mainly exposed to Thai bonds, so the Bank of Thailand's actions impact the most. And weak Chinese economy could reduce commodity demand, hence lower prices, and that means underperformance of commodities. Our commodities could fall with energy prices too, as it's part of the production cost. So the key takeaways. Central bankers appear to be raising rates into a recession to stifle inflation. Stagflation would be the worst outcome. Demand for necessities like food and energy, inflation, and supply chain disruptions can drive the commodities higher. And we see opportunities to allocate to specific sectors and markets within equity. Bonds and gold we have to protect capital. And then we have some risks related to global recession or a collapsing market. Before we get into the Q&A, the Valuation Masterclass 07 is in its final week. We have some friends from within Phenomena. This is a great breakdown of different students in the class. And the next one starts on March 6th. If you're serious about learning about finance and about valuation, come and join us. We had 83 students from 13 different countries starting boot camp 07. Our limited super early bird price is still available. And with our Phenomena coupon code, you can save $100 extra off that. You just get an extra $100 off on any price point until February 23rd, meaning you save $800. Just use the Phenomena coupon and go to valuationmasterclass.com/bootcamp, and I'll see you in the boot camp. All right, it's Q&A time. Time to answer your questions. So let's go through some of the questions. Let's see. Here we go. So Lana Fernandez says, Thai bonds are not doing well compared with global bonds. AWIG is depending on Thai bonds. Any chance? Yeah, I mean, I think the first way to think about bonds is that it's just not where we're trying to catch the upside. So even if we thought, let's just imagine that we thought that bonds were going to do really well. We wouldn't allocate a huge amount to bonds, because if bonds do well, we may see that stocks do well. And the point is that we're going to get a lot more upside in stocks. So we're not usually going into bonds trying to get that upside. And that's really what happened in the bond markets in the US. Now, we also have to remember that last year we were in Thai bonds and the global bonds collapsed, right? And we didn't collapse as much. So we saved some on the downside, but we're missing some on the upside. I think the final thing I would say is that when it comes to investing globally, and you have to protect your downside on your assets, to me, it doesn't make that much sense to invest in global bonds. I'd rather put that money in a local, low-cost money market fund with the objective that it protects the downside. So that gives you a little bit. Will we switch our bond allocation out of Thai bonds? Probably not. But I will take, Lana, I will take this on board, and we will talk about it, the idea of that, in our next rebalance. So thank you for that question, and we will consider it. Next question. Today we say in Thai, one hang kwam rang. Don't know. Hope it's not rug pull. All right. Yes, I don't go out on my Valentine's Day because I'm single, so I stay home with my mom. All right. Here we see CPI, NANSA, CPI data, unemployment data, GDP. You think Fed knows those data or got informed before public or before FOMC? It's many of the data points are not collected and calculated by the Fed. There are some, but not many. They're done by the Bureau of Labor Statistics and other bureaus within the US. So it's not likely that those bureaus are feeding that information to the Fed ahead of time. I would suspect the Fed has their own internal calculations, but as far as the external ones like CPI and GDP, I doubt that they're getting those ahead of the market. All right. How different in oil price if Russia wins or loses the war? Well, I think it's hard to say that Russia would win the war. There's not a lot to win except to say, okay, let's just say that they can control the Donbass. If they can control the Donbass and Crimea, you could argue that they won. And if you say that, then I think that oil prices would come down. The main thing is that, people would expect that Russia would bring more supply out in the world. So I think it would have a natural negative impact on oil, negative on price. Oil price is going to fall. But, already Russia's trying to export as much oil as it can to India and China. And the result of that is that the supply is maybe normal right now. And so it's not like if this war wins that Russia's going to be able to flood the market. Also, keep in mind how stubborn European and US, the Western allies, politicians are. They're not going to welcome Russia back into the global world order. And I don't think Russia is going to be rushing back into that either. So that's what I would say there. Now, let's look at another question here. Now, if Russia loses the war, we should try to answer that one. If Russia loses the war, that would mean that the US and NATO have basically pushed back in the Donbass and reclaim that land from Russia. It's very hard for me to see that happening, but it's possible. Of course, if that started happening, there'd be a risk of nuclear war, but I don't think that politicians care about that. I just don't think that they don't care about anything except whatever it is that they're pushing right now. So if Russia was to lose the war, it's a good question about what would happen to oil prices. I'm not exactly sure, but in theory, oil prices would come down because Russian oil would then be accessible into the market. Now, if Russia won, it would be harder for that Russian oil to come out. But if the US and NATO won, then maybe that Russian oil would come out. All right, next question. Remember, we've got 147 people here. If you've got a question, feel free to type it in the chat, and I'll do my best to answer it. The current, this is from KT, the current Bank of Japan governor term ended on April. Any impact to Japan and developed market outlooks? Well, you know, Japan rates have nowhere to go but up eventually. But as long as they keep them down, I think the yen can be weak. From my perspective, what I would say about Japan is that the market is starting to look interesting. To me, the Japanese market is starting to look interesting. There's so many interesting stocks in the Japanese market that are trading at really good valuations. In fact, my valuation masterclass students are presenting their research on Nintendo. And that research basically is showing how cheap such a high quality company is. So I think there's a lot of things I'd be watching there. All right, next question from Supap. This February, the portfolio is already negative 2%. What do you think you should do next? Well, Supap, my answer is going to sound a little bit strange, but my answer is going to be do nothing. What do I mean? What I mean is that in the FVMR strategy, we have a methodology of how we pick asset allocation. And we have a methodology of when we pick allocation. And that we never, ever break this. And that means that it could be 40 or 50% of the months, let's say, we could be wrong. And there'll be a portion of the months of a year, let's say maybe 55 or 60% that we'll be right. And when we're right, we tend to do a little bit better. And when we're wrong, we tend to not lose as much. So Supap, the answer is we're going to do nothing. Now, a little bit more detail on that is that we are in fact going to do something, because at the end of February, so in the next week or so, we're going to start working on changing our allocations, which we do every quarter, with the objective that we're going to come out with changes towards early March. So at that time, we're going to be considering what to do. One other thing I would say, Supap, is that when you're managing a strategy that is based upon asset allocation as opposed to stock selection, with stock selection, it's a little bit easier to take action because you can just put in a stop loss. And if a stock falls, you can sell it. But with these types of strategies, there's no value in putting in a stop loss. You can consider that our 3-month reallocation or reconsideration is kind of like a stop loss. All right. Nan says, what is your investment style? VI or MI? Or, well, my investment style, I'm going to sit down. My investment style is FVMR. I look at fundamentals, valuation, momentum, and risk, and then I make allocations. And to explain that in a little bit more detail, it's easier to think about a stock portfolio. Let's look at that. imagine that there's 100 stocks in the Thai stock market, and we rank them by PE, from the lowest PE to the highest. And we can say the top 10 stocks are the most attractive because they have a low PE. Now, let's look at those same 100 stocks. And so now let's just assume we assign a ranking of 1 to 100, 1 being the cheapest. And now let's look at ROE, return on equity, and let's rank 100 stocks by return on equity. And let's put the highest return on equity at the top of that list and assign a score of 1. And therefore, if we summed up the score from the PE and the score from the ROE, we would get an average or a composite score. And now imagine every company has a composite score. And then we rank it by that composite score. Now, there's a lot more to it than that, but there's a lot of research that supports it. But that gives you the rough idea of what we do. And eventually, after a series of composite scores that we create, we then are able to identify what we think are attractive stocks in that case, or in ETFs or funds. And then we start to do our research on those. So that's what we do with FEMR. So I'm not really value or momentum on both. Kuna Tip says, with your FEMR model, this is not the good time to invest in China and Vietnam. Not yet. But remember, March is coming. And in early March, we'll announce our changes. And it's going to be interesting if we're going to be allocated to Vietnam and China or not. At some point, we will be. But right now, I would say we're not yet. Peter Pan, Petri Pan. Do you think global REITs already bottom? Yeah, I think it's possible. You know, I mean, I would say yes. REITs got hit pretty hard, and I would say at this point, from my perspective, I would say yes. So that's what I would say. All right, those are the questions for tonight. We have 150 people or so on the call that I can see, or on the video. If anybody has any questions, feel free to ask those questions now before we wrap up. All right, now's the time. Ask your question, just type it in, and I'm happy to try to answer it. Next question comes from Anucha. What is your view on Asian stock markets surviving the recession? Well, I think this is a good question, because what I would say is that Asian markets, in particular, emerging Asian markets like Thailand, never had the benefit of being able to print money and distribute it to their population. The US, the EU in particular, and Japan to some extent did that. And the result is that they prevented their economies from really completely collapsing, although they were already down. In the US, the economy was down by about 8%. So that's still a pretty big collapse. But that also means that Thai people, as an example, or in other Asian markets, never really had it very easy. And then, of course, everybody was locked up for COVID. And then we had interest rates that were never low and no government funding. So basically, the companies in emerging markets and in Asia in general have been put to the test. And the ones that survive are pretty robust. So overall, Anucha, I would be positive on emerging markets, and positive particularly on Asia and Thailand. All right, next question comes from Nan, and it says, good gold trend from now on. Yeah, it's hard to see gold right now. I still believe that we're going to be heading into a recession in the US, and the result of that is that gold will be an attractive protection for portfolio. So generally, I would say the trend for gold is generally upside. Also, remember, dollar down, gold up. If we have dollar down, then we're going to have gold up. So overall, I would say it's not a bad time for gold right now. And you can see in the all-weather strategy, we're 25% allocated to gold. All right. Next question. Keep your questions coming. We have 145 people on the call. Maybe we can get 145 questions. All right, next question. Whoa, difficult question from Kamon Chat. Wheat, soybean, and sugar is the uptrend for this whole year. That's a good question. I must admit that I don't have a great answer on it. I haven't looked at it in much detail. We did see overall agricultural prices shoot up during the COVID time and then come back down and kind of remain flat right now. But overall, I think, higher prices because of supply constraints and other things, I would say, but I don't have a strong opinion about wheat, soybean, and sugar. But it's a good question. I should have some knowledge on it, but I don't have much to say. All right, other questions. Happy to talk and answer any questions that you guys may have. I'm sitting here in my my home office. You can see I love reading books, and I've read many, many books, and there's so many great books to read about investing. These are some of the best books on investing right here. These are books about stock picking. Here's an interesting one on stock picking called 100 Baggers by Christopher Mayer. Christopher was a guest on my podcast and is an old hand in Asia. He knows Asia very well. That one, I just was going through. That's one of the many good ones that I have on my shelf. Next question. I bet my 75% of PVD funds in MSCI, is it too risky? Well, the answer to that question has to do with, number one, how old are you? If you're 30, I don't think it's too risky. You got many years ahead to compound that money. If you're 60, well, it gets a little bit risky. My general rule of thumb that I teach in my book, in fact, right here, How to Start Building Your Wealth, Investing in the Stock Market. This book is actually available in Thai bookstores. I think someone saw it at C-Ed's bookstore, and it's in Thai language and in English. I also have an online course around it. But in that, basically, what I talk about is 110 minus your age. So if you're 40, then 110 minus 40 means 70% should be allocated to equity. That's the general rule. So that's the first thing that I would ask you is your age, and think about that. The second thing is the size of your net worth. If your net worth is pretty big, then you probably could risk the bet. With the stock market, I would say that we're not down, in my opinion, we're not down at the bottom for the global markets and particularly the US, but I would say we're not too far from that bottom. All right, let's continue on. You guys are starting to bring in questions. We got 150 people on that are participating, so I appreciate it. Ball Kampf says, what is your take on Vietnamese stock market? Why isn't it picking up yet? Well, it's an interesting point. I haven't picked up the Vietnamese market through my FVMR scorecard. I haven't looked into exactly why it's not coming into the strategy. I generally look at the ones that are in, but the Vietnam market was pushed pretty hard, and there was a huge amount of flows into the Vietnam market. And so I would say that, it's probably part of it is a correction. But if you look at the Vietnam market, you can say, hey, inflation is pretty reasonable, right, in Vietnam. And so I'm not exactly sure, but I would say Vietnam will have its day again, I believe. But hopefully we'll see a little allocation of Vietnam in our next strategy, review and announcement that we'll do at the beginning of March. Next question from Nan again. Is it disinflation phase now? What sector or stock is good for investment? Tech, healthcare, utilities, financial stock. It's one of the sectors that looks generally good during this time is, I would say, consumers, because the consumer market, the consumer staples basically has good pricing power. So that's one that I would look at. In a deflationary phase, you could also say that REITs could be attractive because REITs basically don't reprice. They reprice by contract. And so REITs is another one that I would look at. In a deflationary environment, you could also argue that industrials could do well because a lot of that comes from financing and from financing industrial products. And if interest rates come down, that's a big one. So those are some of the ones that I think could be interesting. Financials are also interesting. I mean, US financials are in very good shape. And so interest rates coming down. Well, if we think about financials for a moment, think about when you put money into the bank and you make a deposit, you're going to make that for somewhere between probably 3 months and 1 year, and then you'll roll it over time. The average maturity of a depositor is something like maybe 4 months. And so most of the money that the banks are getting are repriced within 4 months, short term. But most of their assets are longer term, particularly loans. So generally, if it's a deflationary environment, it means that the interest rate's going to be coming down. If the interest rate's coming down, that's going to be repriced in the deposits pretty quickly, and it'll be slowly repriced on the asset side. So it generally would be good for the banks. Plus, lower interest rates could mean more potential for faster loan growth. All right. Artosan7, what do you think about some allocation in Bitcoin or crypto? My strategy in relation to crypto, about 5 years ago, I used to say have zero allocation, but I've changed that. I now say have an allocation between 0 and 3% of your total assets. I would say that that's a reasonable amount because we just don't know where this asset will go. And then I've said there's 3 ways that I would look at playing that. Number 1, just buy Bitcoin. Number 2, put 80% in Bitcoin and 20% in 2 other of the largest market cap coins. And another one, if you want to be a little bit more spread out, would be 80% into Bitcoin and 20% divided amongst 5 other coins. But generally, I think the easiest way to do it is probably through Bitcoin. So that's what I would say is about some allocation there. All right, let's see. Yeah, Nan says, cry me, come Tom. Okay, so ask questions if you got questions. All right. Prawiti says, how do you think about the recession in the U.S.? Historical has showed recession if the Fed keeps high interest rate for long. Yeah, I think we are going to be seeing a recession in the U.S. And I think that it's going to be maybe the middle of this year that it'll be here. So I am still expecting some recession in the U.S. And I think that most people don't expect a recession now. They probably think there's a soft landing. So a recession could be hard. Prawiti, one of the things that's different about now compared to the global financial crisis of 2008 is in the global financial crisis of 2008, the banks were in terrible position. But nowadays, the banks are super strong in America. And that means that the recession may not get terrible because it doesn't spread too painfully into the banking sector. All right. Anucha says, how much China stocks will be affected by recession? 20 to 30% decline. Yeah. The problem about the Chinese stock market is it's so volatile that when it starts to come down, it really comes down. But I would also say that the Chinese market's not that expensive now after taking a beating for a while. So I would say probably 10 to 20% decline. China's really got to rev up its domestic economy. It seems to really have slowed down, and the government doesn't seem to be doing much to increase it. Keep your questions coming. Jamoff Cub says, what are your thoughts on U.S. housing market and I guess bonds? The U.S. housing market, I believe, is going to be facing a difficult time. With interest rates so high, what's happening is there's very few sellers because they would lose their very low interest rates. And so without a lot of sellers, then we have, not a lot happening in the markets. And overall, I would say 20 to 30% fall in the real estate market is very possible. And we've already gone through a portion of that. KT says, what's your opinion to be a contrarian on Europe stocks? The outlook is bad, but economic data still looks okay. I would say one of the things, KT, that I'm looking at really carefully is what's happening with our FVMR. Now, we do update FVMR on a regular basis, like monthly, and we look at it and try to understand what's happening. But what's going to be very interesting is, will FVMR pick up Europe in our next rebalance? I think it will. And I would say that I would feel somewhat comfortable right now investing in Europe because it's already been hit hard enough. So I'm not that negative on Europe. All right. It's 7:52. We've got time for a couple of other questions. I want to thank everybody for coming on. I know it's Valentine's evening, and if you're like me, well, you're home alone. And so I'm happy to take questions and discuss. So if you've got any further questions, feel free to bring them out. I wake up about 3 or 4 in the morning. So every time you see me at 7 at night, you may see me a little bit sleepy, but there's nothing I love more than coming on, talking about the strategy, and also taking your questions. And I think there's been some really good questions here. So I want to thank you for those questions. And I think at this point, we'll wrap up tonight's session. And I look forward to early March when we're going to bring out our new review of the strategy, and we'll see if we make changes and what those will be. I'll be very excited to bring those to you. Glissana, thank you so much. Yep. Sati, thank you. You're welcome. I want to thank everybody for coming on, and particularly for all the excellent questions. That's going to wrap it up for tonight. Let's have an amazing rest of our Valentine's Day, and let's make the rest of this year great.